welcome to the Shared Practices podcast. This is a fun interview that honestly, we haven't had an interview like this in a long, long time. And our listeners are hungry for this because one of the things that we get from new grads, from associates, from existing dentists who are running their practice is I want to get more money to buy a practice or start a practice in the first place, or to expand or build a new building. Like, how hard is that in the current interest environment, the current lending world that we're in? Is this going to be a problem? Am I bankable? Is this practice bankable? Um, and then moving forward, how do I get this all to fit together? How much money do I have to bring to the table to pay for closing and attorney fees and coaching and all these things? And so I'm really grateful to have with us today some longtime friends, longtime partner at Shared Practices, Provide. Steve Steinbrunner, welcome to the show. How's it going, Steve?
Great. Thank you for having me, Richard. Pleasure.
Super excited to have you on. And then we've got Brian Carroll, two R's, two L's. Brian Carroll, how's it going, Brian?
Doing great, man. Thanks for having us.
Well, sweet. We're gonna have a great conversation today, and I will say that I went on your guys' podcast a little while back, and you guys sent me some sweet swag for coming on the show, and my daughter wears a Provide shirt to bed at night. You know, it was like a real soft, like just awesome shirt. So it's funny. There's like a little Provide billboard walking around my house at night. And then the Yeti that I got from you guys is just good stuff. So if you guys ever work with Provide, like, and you sign up for a loan, hit them up for some swag and see what they can do for you. Yeah. So one of the questions that I think every pre-owner, and we're talking about pre-ownership here. This is the potential future acquisition, future startup. We've got an event coming up Friday, July 25th, July 26th. This event is our Pathway to Practice Ownership event. You guys are going to be there, and you're going to be able to answer questions, help these dentists out, help them get not only the right practice, but money to buy or start a practice. And so this question of like, can I get the money? Can I do this? Is this reasonable? Is this feasible? Is a question we get all the time. And there's a lot of dental lenders. And unfortunately, there's a lot of friction. I've been through a couple lenders, and I remember when Provide first popped up on the scene, and it was just the smoothest process to get like pre-qualified to see if like, can I even get a loan, versus every other bank, every other institution. I felt like they were 10, 15, 20 years behind, where it's like, I can get pre-qualified for a mortgage in seconds. I can get loans all over the place. And how is this such a big ordeal to even start the process of looking into dental lending? So, I want to start there. Qualifying as a dentist for a loan, in particular, a pre-owner. We get that question all the time. What matters? What counts? How do I get a loan? And I'm going to start with Brian. Steve, I'm sorry. Steve's all about new projects, startups, expanding offices. And we have this slight acquisition bias at Shared Practices. So I'm always going to hit up Brian first, and then we'll go over to Steve next. So Brian, tell me about that new grad or the associate that's been working 2, 3, 5 years. They want to get a loan for a dental practice. What do they need to bring to the table in order to qualify? And how does that all work?
Really good question. I would preface it saying it's very important that you use a dental specific lender because that can really have a huge impact on what kind of finance you can obtain, different rates, different structures. So usually, in the realm of practice financing, most banks are looking at about four main metrics. So the acronym I like to use is CPLT. So credit, production, liquidity, and time licensed. So kind of
Okay.
just starting from the very beginning, time licensed is usually banks want to see about a year of associate that can get replaced with either military service or residency program. Now, each bank's a little bit different. We are a little bit more common sense approach. So we have done doctors within 6 months out of school, or there also is an option through the SBA lending, so Small Business Administration. If they're gun ho, they have a practice lined up day one of graduation. That could be an alternative. outside of time license, we're going to be looking at their credit. Primarily, we want to ensure that does this individual pay their bills? Is it likely they're going to pay us back? And really wanting to make sure there's no blemishes on their credit history. So, short sale, bankruptcies, a lot of delinquent payments. So, as long as you have a pretty healthy credit score, that does the trick. Um, as far as expenses go, that can have a pretty big impact of what kind of loan you can get. So the biggest question we field quite a bit is, what do I do with student loans? Logically, you think, okay, I'm coming out of school with $500,000 in debt. I probably have to pay that debt down first before I can obtain another 500,000 to $1 million in debt, which I understand that logic, but unfortunately, with banks in this space, they say, hey, we know that debt's going to come with the territory. Leave that in place until you get in the practice and you can start paying down some debt. There's a difference between bad debt and good debt, right? So we'd much rather keep that debt there and have you stow away your cash, because nowadays cash is king when it comes to the bank. So that liquidity metric, and what that term really is cash in the bank between checking, savings, any marketable securities. So usually bank wants to see about 7 to 10% of the total loan amount. So there's some creative ways around there for new grads if they haven't amounted that kind of liquidity. There's what's called a gift option. So what that means is every bank's different, but usually they have a metric or a threshold saying, hey, as long as you have about $35,000 to $40,000 in your bank, you can then utilize what's called a gift. So anyone financially invested in that opportunity can kind of bridge that gap, inject the difference, and kind of make you whole to meet that threshold.
It's funny that you say that because I actually had to do that. I got an SBA loan for one of my loans, and because I wanted to immediately add a CBCT, I wanted to add and expand some operatories, and it's funny. Every time I've hit up Provide, I have like a weird loan that I want. You guys are like, we like the standard thing that everyone does, and I'm like, well, I'm weird, and you're like, oh, okay. So I had to get an SBA loan, and I don't think you guys were offering those at that time. But I had to hit up a family member, my parents, and have a kind of gift situation, and I paid that back, and we were able to get the loan done. But I think going back to what you talked about overall, that liquidity piece is something that was really important to me in the first seasons of shared practices, was because I've seen that happen. I've seen people who are like so proud of themselves for paying down $100, $200, $300,000 of their student loans, and they're like, now I'm ready to buy a dental practice. The reality is, if they just squirreled that away, just stockpiled cash, they could have gotten into practice ownership sooner, and then they would have had a much bigger shovel. It's like you go from like digging the hole of your student loans, trying to fill it in with like a shovel. Now you've got like a bulldozer to fill that in as a practice owner, and delaying getting into practice ownership because you don't understand that liquidity, cash is king, is heartbreaking, because it's like you've done all that work and you paid student loans. I'm glad you brought that up. It also feels weird to like not invest that money. Like, I think there's a lot of dentists, like, you can have it in market, things that you can
Stocks.
access, but at the same time, like, I wouldn't want to have my liquidity for a dental practice like fluctuating in the crypto markets. Like, you kind of want to be a little boring with this money. And for a dental student who's really ambitious, really entrepreneurial, they're wanting to invest, they're wanting to grow, but just having 50K in the bank feels really, really good. If you can be, a year, 2 years out of dental school, you've got that length of graduation since your time of graduation. You've got a decent credit score. You've got 50K in the bank. 50K to 100K is usually what I tell people. That 100K, if you're trying to buy a bigger practice, is where you want to be. But I wanted to ask the personal side of qualifying for these versus almost the credit worthiness of the practice. There's two sides to this, and people think like the big deal is the personal side. I actually feel like all the banks I've talked with, the personal side is kind of like checking the box. They're like, all right, we're good. And then it really comes down to, is this practice worth lending on? So before we go there, because I realize I've neglected Steve over here, um, does this change with startup versus acquisition? Because an acquisition, it's an existing practice, an existing asset. And so getting like real creative and buying through SBA straight out of school, I don't know. On the startup front, can we do that? Is that length of practice history, production history, your expenses, does that weigh heavier when it comes to the startup world, or is it kind of equivalent?
It's a real good question, Richard. Startups are very different because they're going to weigh more heavily on the personal side. We don't have a practice on the other end that's unique, big, large, profitable, or not. We create our own projections on the startup side based on how we think a general dentist should perform over the first 3 years. It's our own model. And it's why we don't require for a conventional loan that a doctor provide their own business plan, because we've kind of got ours.
They're like, we understand. This is a dental practice, guys. If you do it
That's
right,
right.
here's how it goes.
And that's, I mean, in simplifying it, that's really what we're doing is we're kind of making assumptions based on what a general dentist should be able to produce in year 1, 2, and 3. Now, what we have to plug in there is what are some of the variable expenses that are different with every startup? Well, one's rent.
Hmm.
That stands out real quick. So banks, interestingly enough, are typically concerned with what is your rent per month the first year?
Okay. The runway, those terms, because you can
The
get real
runway.
creative with landlords. And depending on how desperate the landlord is, they'll, 6 months of free rent, that's a big deal.
That's exactly right. And I tell borrowers to use that in their negotiations because to the bank, it's keeping that rent reasonable. And it can vary per borrower and it can vary depending on where you want to go. As you know, you might have a doctor going into a higher end retail space in a downtown metro area versus a more rural location. That rent's going to fluctuate. But the bank's concerned about what is that rent year one. So the borrower can use that to negotiate some things that may be important to them with parking and free rent and escalated rent and all that other stuff in order to make sure that they get in return some reasonable rent on that side. But to your point, the personal side comes under more scrutiny. And Brian brought up some of the great, initial hurdles, so to speak, that we need to get over. And they're the same for startups. A reasonable credit score. Typically, we like to see a minimum credit score of about 680. We like to
Okay.
tell people. And if it's not, investigate that. And I'm sure you advise people all the time to pull your annual creditreport.com and realize that the federal government will allow you to pull your own credit for free once a year and dig into it and find out why your score may not be adequate. Liquidity remains equally as important to Brian's point. We'd like to see 7 to 10% of what you borrow again. And a startup loan for a general dentist might be $700,000 or $800,000 today.
Okay.
They, as an associate or a general dentist, rather, we would like to see them work for 6 months to a year out of school. However, specialists, orthodontists, pediatric doctors, et cetera, can generally obtain an approval immediately out of residency and open a project once they have their certificate in hand. So a little bit more accelerated on that side.
Okay. So not too far off of like you can still get a startup loan fairly quick out of school. Maybe that
Mhm.
minimum credit score might be a little higher. Liquidity, is there you said did you say about 10% of the total loan?
7 to 10%.
7 to
And,
10.
and again, I mean, depending on where that falls, we start to look at other criteria for the borrowers. And to Brian's point, a responsible borrower means everything to the bank.
Hmm.
And you illustrated that, Richard. If somebody can have, 50, $60,000 in the bank, they've got a reasonable credit score, they have a clean license. Generally, when we get through those initial hurdles in our pre-qualification, we have a very high expectations of, approval here. But also with a startup, we don't always know what's behind the curtain with personal expenses. So as people progress through the application, that's where mortgage payments and car payments and additional lifestyle becomes revealed that could still cause a problem with approving a startup loan. So our advice is to try and keep that lifestyle reasonable, maybe, until we can get through the startup loan application as well.
Do factors like continuing to work part-time somewhere else, 1 or 2 days, does that impact the ability to get a loan one way or the other?
Absolutely. I won't speak for Brian, but certainly for startups, we're going to want a borrower to maintain an employment associate position through the project. And when they open the doors, if they can for a day or two, we don't really dictate what that looks like, Richard, but if they can keep that income there, absolutely. That's
Okay.
kind of what makes the cash flow work as we ramp up. And I'd like to share with people in general terms, the bank wants you to succeed. So we build in, we use the word runway. We on startups also have a 2-year interest only payment.
Mm.
So for a startup loan, that might be $3,300 a month for the first 2 years as your loan payment before the principal kicks in and it's $8,500 a month, for example. So we want to be conscious of what that loan payment is and the burden of that in the first few years, even for a startup, so that we grow our payment with the practice, so to speak.
Well, between a loan that starts off very reasonable and the rent, we were talking about that. If you can negotiate, escalating rent where, it's not as bad, maybe it's not free, but not as bad at first. And over the first year or two, kind of escalates. You can buy a lot of breathing room. So what it sounds like with acquisitions, it seems pretty straightforward to kind of check the box, and that the approval process isn't a super long one. Like, it's kind of in this, as you're negotiating practice price, as you're doing due diligence, it kind of syncs up and lines up, and it's like, okay, we can check the box on you as an individual. Now we got to check the box on the practice and make sure there's no skeletons in the closet, and then it all makes sense. But it sounds like on the startup front, it's almost like a bigger window of like, can we do this with you? And even things like the rent, because it's like, okay, do I have the green light on my loan and then I sign the lease? How does the lease, signing the lease and getting the loan interplay? Because you talked about that, and maybe they have identified a potential location but not signed the lease and they're in negotiations. I don't know. Now I got questions. Now I'm like getting in the weeds here.
These are really good questions. And so there's never a perfect timeline. And for every doctor, it's different. Some people like to have their approval done very early to give them the reassurance that it's there. And certainly some people wait till the last minute and they've signed the lease and then decide they have to go get money. The right answer is probably in between, but getting your approval early is really smart. Here's why. Provide doesn't issue a hard credit check on our approval process. We do a soft pull. So there's no negative impact to a credit score. There's no fee. So why wouldn't you? And if it takes 2 or 3 weeks for you to get formally approved, we can put a placeholder in for rent. Let's make an assumption that rent may be 7,000 a month for now. Okay, we can come back and revisit that if you find a place where it's a little bit higher. Because
Got
we
it.
we have a team here and there's real people behind this, Richard, right? So, I kind of remind borrowers that it may seem sometimes like you put a ticket into a machine and get an approval out the other side, but there's real human beings that consider each situation that's unique. And so we may issue an approval for $700,000 for rent with 7,000 a month, and we change that in a few weeks as they find a space that's a better fit. To open the project, we really only need a draft lease, some bank accounts open, some entities ready to go, right? Very easy. Um, but as we know, sometimes rent's negotiated right up till the last minute. So we've got flexibility there.
I just started, my brain started going down the rabbit hole. I appreciate you clarifying there. Well, this comes to now, I think, where we'll go back to talking about acquisitions, Brian. There is a very real sense that the bank should be a really good data point of whether or not you should pull the trigger on a practice or not. If the bank is getting weird about a potential acquisition or a startup site, an opportunity, they probably know something. And that shouldn't be like, oh, this bank is dumb. this is frustrating. Like, why won't they give me the loan? It should be like, should I be doing this? Is there some things here that are really concerns? And this, in my mind, comes down to exactly why we hold our event. There is the difference between a ready to grow practice, which is what we talk about, buying that office that has low hanging fruit, that has immediate opportunity for growth and expansion, versus the ready to shrink practice, which is, unfortunately, I've had a number of conversations with doctors recently who have bought practices that in retrospect they really shouldn't have. And I don't know why their bank lent them this loan. It wasn't Provide. I don't know why they didn't have better buyer's representation, where as soon as they buy the practice, there's a devaluation because they can't. There were skeletons in the closet that were misrepresented. They didn't do enough due diligence, and or they can't replicate what the previous doctor did, like a doctor who did all of the high-end cosmetic dentistry on every last little patient. And there's not a lot of new patients coming in, and now the dentistry is like basically done on a smaller patient base. So with that being said, um, Brian, when you guys are looking at potential acquisitions, what are the red flags for you guys versus the things you get really excited and they're like, oh yeah, this one's going right through. Underwriting is going to love this. Like, we're going to get this thing approved. Where, as a bank, do you start to see those signs of health or concern?
Yeah, and going back to your initial point, it's very different where a lot of our buyers kind of try to tie it to getting a mortgage for their house, right? They say, well, how much am I approved up to? Where it really varies in practice financing, we're heavily relying on that practice. So you could be a great buyer, but it might not be the right practice. So at the end of the day, we are a healthcare kind of finance cash flow lender. So at the end of the day, we want to ensure that practice can sustain not only the new practice debt, but also all your personal expenses. So usually, the first thing we do when we collect the financial package is we'll get the past 3 years of returns and then a year-to-date P&L, and we're going to really kind of comb through that really pretty diligently with a fine-tooth comb of looking through every margin, saying, okay, how much are they paying themselves, staff, what's rent like, any other kind of one-off add backs as far as owners, families in there, maybe some meals, entertainment, some hobbies being filtered through there. So we really want to ensure that we have a really good idea historically what that take home is. So we like to really educate our clients to say, hey, if you don't change one thing about this practice, we are going to walk you through what you should anticipate taking home from a gross and net standpoint once all your debts are taken care of, just so they know financially what that looks like. So one, we want to get a gauge of the revenue trend to see, okay, is it increasing? Has it flatlined? Is it decreasing? If it's decreasing, it's probably a red flag. We're going to dig into that. Okay, has he got one foot in the door for retirement or what's going on there? Another is, to your point, of production capability. So we'll back out the hygiene and say, okay, how much is that owner actually producing? And then we'll go to our borrower and say, okay, how much can, historically, which we know you can be handcuffed depending on the associate position you're at, right? So even if those aren't dollar for dollar, that's fine. We're just going to cash flow on our end, factor in an associate getting plugged in to bridge that gap. But we do usually want to understand, what kind of procedures are being done in the office, and can our buyer do that, or what their plan is to keep that momentum going.
And you mentioned something as well, which was a decrease in collections or productions. And this is one of these, like, this is a nuance that multiple things you mentioned were nuanced. I mean, even looking back at 3 years of profit and loss statements, one of the funnest parts of being a dental practice owner is all the like expenses you can legitimately run through your dental practice to decrease the profit of the practice on purpose to decrease your tax load. And then when you go to sell it, you have to like back all that out and say, well, actually, I was paying my wife and paying my kids here and this expense and that expense. And so sometimes when you see a profit and loss, like the broker sends you over, here's the production, here's the tax returns, here's the profit and loss statements, there can be this sense of like, oh, well, this actually isn't that good of an opportunity. But they're playing funny business, which is fun. Like that's the whole point of being a business owner, is that you can invest in your business, and you can also use it as a vehicle for you know, reducing your tax burden. Um, so that has a bunch of nuance, and so you guys care a lot about combing through and accurately representing what is the true income of this practice. The other thing that has a lot of nuance, and this is why it's really fun for us to work with you guys as buyers representation and as a bank. We're really aligned. Like we want to understand the intersection of the financials and the intersection of the what's going on in this practice on the practice management side. So you talk about a dip in production. If there is the same patient base, like you actually have the same number of patients, the same number of hygiene visits, and the diagnosis and the production from the doctor has dropped off, like in my mind, that's actually a good sign. That's like this doctor's getting lazy. Like he just doesn't want to do more dentistry. They still have the same patients. He's putting a lot of watches on things like, it's just a filling. We don't need to crown and root canal that, versus a practice that has legitimately declined overall. The patient base has declined. There is, reduced, the insurance or insurance participation got worse. They're like losing patients and adding more insurance, and the practice isn't producing what it used to. So having a combination of a perspective of what can be done with this patient base, which is what we really look at, with the historicals, which is what you guys have to look at. You can't say, here's a magical fairyland where we see what is possible and tell you, okay, we can approve you based on the fact that you can probably, with shared practices, you could add $500,000 of production to this practice. You can't approve that loan. You can approve the loan that is based on the current financials of the dental practice. Is that fair to say, Brian?
Yeah, I would say most turnkey offices, that is correct. We do have a unique product that is called a jumpstart model. So a lot of banks have this, and it's really kind of a hybrid between the turnkey office for a doctor saying, hey, I don't want to buy $1 million practice that's already kind of built out. There's not much growth potential. But they also don't want to spend 9 months with Steve and building it out from scratch, right? So they want to find a blueprint of an office that has, the opportunity and the foundation of a good office. Just historically, it just needs the right clinician. It's being underutilized. So, maybe it's a satellite office or the seller's already kind of in transition to retirement. So a lot of these doctors, and we have the data now that shows these can be great opportunities for the right buyer. So to your point, we'll look at that kind of off projection. So we underwrite it very similar to a startup. We go off projections. We'll give them 2 years of interest only payments, adequate time to ramp up. And it really helps that they have members on their team like yourselves that can educate the client to say, okay, this is kind of the blueprint to get this practice where it is today to where it needs to be in a year. So
And
that, yeah, go ahead.
Well, and I was going to say, for us, that jumpstart practice, we like the ones that are 800,000, and we can add another doctor and a hygienist and take that to a $2+ million practice. Most doctors think of those jumpstart practices as like a pseudo startup $300,000 office that they can take to 500 or 600. So that really is the whole point of our seminar, is the difference between, sure, you can do a pseudo startup, which can work. It can be great if it's the right opportunity. But we're looking for that like different kind of jump start. Like this is already a healthy asset, and you just add a little bit of the right things and the right drivers, and all of a sudden you've more than doubled the value of the thing that you just bought a year and a half ago. So that's the fun part, and it also takes a little more patience. It takes the due diligence to understand what you're looking at, what's possible. And then you get to combine it with real estate opportunities. Steve, we'll talk about this in a second, of like, okay, now what do I do? I've maximized the potential size of this dental practice. Maybe I need to go build another office. I actually have a friend right now who's got ground and is building a 20 op practice. He's going from 8 ops to 20 ops. He's got the demand. He knows what he's doing. He's been coaching with us for a number of years. And he's going for it. And so those are some big loans and exciting things. Um, But going back to the acquisitions, I had a few more questions. Maybe there's questions I'm not asking. First off, the cool part of why we love working with you guys is you guys help bundle together the things that we help people do so they avoid those ready to shrink practices and they find those ready to grow practices. So I think as a first time buyer, you're worried about like, okay, I have to pay attorneys. And if I pay someone to do the due diligence, I got to pay them. And then I probably can't afford a coach. And you guys actually will bundle all of that together with the loan. So at Shared Practices, we have our attorneys in house. We do the due diligence and then we coach people through that first year of ownership and beyond. And it was really cool to establish the relationship with you guys where you said, yeah, we'll pay for that on top of the working capital, include that in your loan, and allow you to have that breathing room and that help. Tell me a little bit about why you guys would do that, because it's just more liability. It's more money that you guys are throwing at the same loan. Why would you do that?
Yeah, and for our standpoint, knowing kind of the data set that we see with the clients you work with, it's a safeguard for the bank because we know they have the right partners and team in place to kind of guide them and coach them and making sure that practice is successful. So for us, it's a lever point that we can utilize so they're not having to come out of pocket day one of practice ownership and really setting them on the right pace, stretching that over 15 years. So that payment's pretty small when you're stretching that over, 15 years versus day one, them dumping out a bunch of money, out of pocket.
Well, and I love the fact that you guys say like, actually, that's the safest thing we could do as a bank is give you coaching, not only on the acquisition, make sure you have the right representation, and then through that first year of ownership, as a bank, you're like, why wouldn't we do that? We're going to grow the asset. We know this thing is never going to go belly up because right out of the gate, they've got all the right support. So I just love that. I love that it benefits you guys because you feel much safer and much more comfortable with that loan, knowing the doctor has that support behind them. I did want to ask on last acquisition. I promise, Steve, we're going to come back. We're going to come back. Um, is there a max for that first time buyer of like practice size? Like where does provide get squirrely? Because I like to like push on you guys and figure out, okay, if I wanted to buy a $2 million practice or a $3 million practice, like where does it get weird versus where is it like, oh yeah, all day, every day?
Yeah, and it's tricky too because the landscape has changed quite a bit. Post COVID, a lot of consolidation has gotten into the market. So a lot of these practices that historically are collecting north of 1.5 are getting gobbled up by DSOs. So there's not as much inventory for private practice ownership for those larger practices. Now, I would say you're right on point. About 2 million, I would say, is the sweet spot on the upper end. Really, we're still going to look at our foundation of okay, do they have the cash metric? What's their production like? And at the end of the day, does this cash flow ensuring that everything's secure?
I looked at basically a $2 million practice once. It was a $1.9 million purchase price. That's what the collections were. And this doctor was a super GP. It was like him and one associate, and he did like every procedure under the sun. And there was not room for growth on that practice at all. Like they'd already maximized the operatories. He's doing all the procedures. And I just felt like if I bought this, there's like right away it would drop 300K at least in value because I'm not this guy. I'm not as good at all of these things. He had all the toys. He had the Omnicam and the multiple CEREC machines and implants and all the things. So ironically, you really have to know what you're doing if you're trying to buy that 1.5 to $2 million practice. There really has to be opportunity to grow. Otherwise, go find yourself an 800K office and grow it into a $2 million office. Like that's what we teach. That's what this course is about is create for yourself instant wealth, instant cash flow, instant growth over the first 18 months of practice ownership. And when you buy the right practice, we've had interview after interview after interview of people coming on shared practices where they use our due diligence. It's a year out. They've grown it 30, 40, 50, sometimes up to 100%. That's not going to happen every time. We're sorry for everyone who doesn't do that, and they're mad at our show because we promised them practice ownership would be this pot of gold at the end of the rainbow. But if you buy right, there really is amazing opportunities. And if you buy wrong in that 1.5 to $2 million range, the chance of things going upside down gets higher and weirder. So I think you really have to be a very intelligent buyer in that range. Is that fair to say?
Yeah.
Okay. Steve, on that same question, I'm going to come back and say, okay, I'm I'm an ambitious new startup doctor who's like, okay, I want to build an ADOP practice. I want to build a little bigger startup. Where do you guys start to hit those ceilings of like 1.2, 1.5 million? Where do I need like 400K in the bank for you to even talk to me when we're looking at loans that big?
That's a real good question. I mean, remember, startups are going to be a little bit different because we're still using our own projections. So to see a general dental startup exceed $1 million is rare. You're not going to have that swing that you have in acquisition because an acquisition cash flow is cash flow, right? And so if a large practice is pushing off enough income, it's okay. You're going to be able to make the payment, but not so much in startup. So startup's going to be a lot more static in terms of the size of the loan, despite the borrower. Now, I've seen borrowers that have a lot of cash, that are very strong on their personal financial statement, push that envelope up a little bit with startup, but not a lot. What changes, Richard, is once you grow the startup and become an established practice,
Hmm.
then underwriting looks at you completely differently because now you're only as good as the equity and revenue in this practice that you've grown. And that's where it becomes really interesting for a doctor who's given it 2 or 3 years to grow that practice with strong revenue as they begun to pay their debt down and build that, what we call equity or goodwill, that you might call it, because that gives the doctor now a lot of power as an established doctor. But a startup loan is going to be much more of a rigid framework in terms of how much we're willing to lend.
Okay, well, I'm gonna keep pushing. Is it back to that like 700-800K, or like where is that top out for Provide typically?
I mean, on a general dental practice, I've seen them push upwards to 900. If it's a really
Okay.
strong doctor, maybe $1 million. We see that on the specialty side. We're going to see it a lot more often.
Hmm.
With multiple doctors, it's a lot easier because we have two borrowers now, right? We're spreading the
Mm.
risk out. That always brings a little bit more power to the borrowers when you have two. It just kind of depends. Now, having said that, two doctors doesn't necessarily mean you're going to have twice the startup size. And it makes sense if you think about it from a, kind of a logical point of view. You have two borrowers under two different households that may be business partners with two different sets of expenses that has to be supported from one practice.
Well, the first couple years, I mean, I have a buddy who um, ground up, I tell people like, if you do ground up, it's just going to take you an extra year to 18 months. Like, don't do ground up. Go find a gray space and like build out an existing visible area that's got good demographics. But he's like, no, we want to do ground up. We want to do it here in Texas and put a big old like massive flagpole out front. And he wanted to do it with a partner. And they wanted it to be big enough for both of them. And they kind of had to get a partner on the real estate. And then I don't know if they had to do SBA to be able to do all that. Well, it's a longer ramp up time because to have two doctors worth of production takes double the patience. It takes
That's right.
double the marketing and double the
Right.
time to get that far. So I agree in that, like, it's kind of like you both have to go then be associates somewhere else for
Mhm.
a long time before you can then both be full time. And you need to make sure that that's the eventual end goal. So yeah, I can see how that wouldn't necessarily change the equation too much. Um, and I will say what you talked about with me before the call is what a lot of our doctors at shared practices, it's the problem we create for them. It's a great problem to have, which is you buy an acquisition, you grow it to the maximum size of what you can fit in there, and you're like, man, this worked. We know what we're doing. We know how to add hygienists. We know how to add doctors. We know how to scale. I want to go from 7 ops, 2 doctors, we're just like crammed in here like sardines, to 13 ops, 3 doctors full time, 6 hygienists, plenty of breathing room, a staff room that's actually the appropriate size so we can train everyone in one space. Um, that's the kind of loan you're talking about. And really cool if you can do the real estate and the expansion, even if it's kicking out a wall and adding a few ops into the next space, or like we were talking about just now, ground up. There's some real opportunities for having multiple assets. Talk to us about that a little bit.
Really, really good points, Richard. And I'm working on all of those examples. I mean, you can take a doctor that may want to expand, for example. Even conventional underwriting is going to look at that situation and give them credit for their growth. Moving from 6 operatories to 12, we can look at the additional operatories and plug a number in to give them credit for additional production.
Hmm.
Well, the benefit of that is it now allows us to give them a greater loan for the relocation. That's one of the challenges for a lot of doctors that want to relocate is getting enough money because it's often based on how big is your practice, right? What's your revenue versus your debt? And if there's goodwill in there somewhere, which is the difference between your top line revenue and the loan that you have, that's real. And we talked about this before. So now the bank looks at you differently because that, if you had to turn around and sell your practice, Brian knows this, you would sell it for the essentially the annual revenue as an example. And something else pretty cool could be that is used for construction dollars for a loan, maybe for new equipment, but it can also be used for a real estate down payment.
Hmm.
So, to your analogy, let's imagine that you have a house paid off and you want to build a pool in the backyard. You go to the bank and the bank's going to say, well, heck, you got all this equity in your house. You don't have a loan on it. I'm happy to give you a loan against your house to build the pool in the backyard. Well, we do the same thing with commercial real estate with a dental practice. You have an established doctor that's worked hard to build up to $1.5 million practice with now a small loan left. Well, we're happy to lend them the 20% down payment that might be required on a conventional real estate loan. So if you have that down payment loan sitting right alongside your construction and equipment against the practice, now you have the remainder of the real estate in its own loan, which you'd be paying yourself rent anyway. So that's just kind of replacing your monthly rent. And you're 100% financed. So we're able to help established doctors purchase a building, relocate into it, expand their space for no money out of pocket because they've worked hard on the practice and they're getting credit for that.
I love that. And I think there might be someone who's like, well, why is that so important to do? And this clicked for me when I started explaining to patients patient financing for large procedures like all on four. And I would have to tell them because they'd kind of freak out when they'd see the interest rate. They're trying to get a loan for $40,000 to do implants upper and lower, and I'd tell them, well, when you get a mortgage or when you buy a car, the banking against the asset. They can come back and repossess your house. They can come back and repossess your car. And so it's not as big of a risk for them. But when they pay $40,000 just out of the blue and they can't take those teeth back, they can't take the implants back, they have to charge you more. It is a bigger risk. Your interest rate is higher. So having this goodwill, this equity in your dental practice that allows you to go do these next projects and expand or build or buy real estate is allowing you to have access to better interest rates and have access to capital that people wouldn't give you. The banks would say, no, we're not willing to do this otherwise. So that's really cool that you guys have the flexibility and the tools, especially with our entrepreneurial dentists, the ones that bought that ready to grow. They've turned it around. They've added a significant amount of production because it, the one part about that that feels kind of crappy is that I just bought a practice. I have this big acquisition loan, and here I am 2 years later thinking about what feels like doing a startup to go into a new building. But when you take into account, okay, yeah, here's your original loan, but you've doubled the size of your practice over 2-3 years. And now the value and your profit is even better than that. It's not just doubled your profit. Maybe your profit margin's even bigger as you scale. And so the value of your asset is so much more significant than that loan that is still sitting there. And you run the numbers, and it makes sense to take on this bigger loan to go expand and have a bigger office or kick things out. So this has been a lot of fun. I feel like in the last 7 years, I've actually, done a lot of weird loans of like, okay, 2.7 here and $1 million for this practice. And then we did startups for denture and implant offices. And I've seen so many dentists be scared of lending, as like that would be a barrier for them to get into practice ownership. The reality is they just need the right partner. And we've vetted a bunch of banks. We've worked with banks. We've had banks on the podcast. You guys are the ones that we send everyone to. And so, and if Provide says no, once again, I'm going to go back to, you should start questioning whether or not you should be doing this anyways, rather than being like, oh, Provide, they're a bunch of jerks. You should be thinking twice of like, what's going on here? So we really appreciate having you guys at this event. For people who have more questions, who want advice on their specific situation, and want you guys to look at like, okay, here's what I'm coming to the table with. How would this work? Come join us in July for our Pathway to Practice Ownership. And thank you guys for coming on the show. So Brian, Steve, it's been a lot of fun.
Thank you, Richard. Appreciate you.
Awesome. We'll talk to you next time on the Shared Practices podcast.